Hi, this is ProXam. Welcome to this live webinar. Today we're looking at the budgetary impact for expats living and working abroad. So we're previewing that budget and some of the things that already been announced. So have a look at and follow our YouTube blog at proactpartnership.com to follow up and get a clear understanding of how the impacts will affect expats in the UK and living and working abroad. We're also going on to Twitter Spaces as well. We're going to comment in that can run all the way through the budget afternoon, so we can consider any facts there. If you've got an inquiry, you should contact us at partnership.com, and where we offer free reviews and online advice. We've got a retained client service where you can sign up and get online advice and guidance to answer your questions about expats living and working abroad. So I'm just opening up now the Twitter Spaces. So just want to say welcome to those people. Follow us at Partnership on Twitter. ProXam says for insight information on living and working abroad. So it's big budget time. It's a big decision for the UK, but it's a big decision for everybody at the moment. There's a lot of things going on, and we're in a world of turmoil. It should have been bleeding obvious on what they were doing. As soon as they applied the coronavirus stimulus cash to the economy, it was going to have an inflationary effect somewhere down the line. So there's lots of changes going on in the economy that have impacted us over that period since the COVID period. And the world's got to come to terms with that. So was COVID like a depression area? Was it like a stock market crash event? Was it like a bank collapsing event? We don't know. But it will have an impact on our world living and working abroad. And for that, we need to look at and examine exactly what the situation is and how that's going to impact on us. So those issues are all around us at the moment. Now, one thing that we do have is we have high inflation. So when interest rates go up and investors can get more money from their interest rates, stock markets will go down, and that's the way of balancing that out. Higher interest rates has an effect on mortgages, so people are more inclined to cash in that mortgage and not maintain that process. So that can have a depreciating effect on property assets. Once the markets presume that everything is going to recover and go well, then the stock markets will recover ahead of the game when people see business opportunities arising and profit that can be made on capital and dividend investments. So that's the difficult world we're in of a recessionary period. And it's what is the best way to fix that? Is it the same way that Britain has been doing since the banking collapses in 2008, 9 and 10? Or should there be a different way forward for the world at the moment? And this is what the policymakers are trying to get a grasp on. We're living and working abroad, so that's a bit different. So let's have a look at some of the things that are looking at in the budget that impact expats. So there's two types of things for expats. There's expats living and working in the UK, and there's expats living and working abroad. So some of the things we're talking about are only relevant if you've got a tax footprint in the UK. So you could be non-resident to the UK and have no taxable income in the UK. Now that depends upon whether it's fixed in the UK or it's outside the UK. And this goes for any country at all. So certain types of income and capital gains are fixed in a country, in a tax jurisdiction, irrespective of where the individual that owns the right to that asset is living and working. So some items are always going to be taxed in that country. So you could be an expat and still have a tax liability in the UK if you've got capital gains, if you've got property sales, if you've got property rental income. And that's some examples of fixed income that's arising in the UK. So as an alternative, that you've got things that move with you. So movable income is things like interest, and it's things like dividends. So if you're a contractor operating your own personal service company or working as a nomad across border, you can take dividends from a UK business or overseas and then pay that in your local tax jurisdiction. That will be a way forward. So, quite an interesting scenario about what you could do that. So dividend taxes in the UK are going up, but that's irrelevant if you're an expat and you're tax resident abroad, because that tax doesn't apply on that dividend source income. So with a UK service company, but the beneficial owner tax resident abroad, they can get taxed at the tax rate for those dividends wherever they're working abroad. Now that might be more than the UK rate or might be less than the UK rate. With a UK company, got a flat rate of corporation tax, which is still 19% pre the budget for small companies. It's only going up to 25% for bigger turnover companies. So if it's still a flat rate of 19%, then if you're in the right country abroad, you could pay 0% tax on that dividends. Examples of 0% tax on dividends would be Dubai, UAE, or Cyprus. Other countries would allow you to only pay tax on remitted income. So you could receive dividends from a UK company as an expat, but not pay tax, for example, in Romania. So they're the options, the different considerations for different people. In another jurisdiction, you might pay a high rate of tax. So, this is the decision that you make when you're relocating overseas or investing offshore. And for more information and guidance on that, contact us at productpartnership.com. So being a nomad, using a UK company is a cheap, flexible way, as long as you've got your tax residence elsewhere, and the maximum rate of tax you're going to pay is your flat rate corporation tax in the UK. Unfortunately, personal allowances are at the moment being frozen in the UK and not being upgraded, but that was after a big change in the last year. So the personal allowance in the UK is 12,570. That's set to be fixed for the next 5 years. But if you've got no earned income above that level, you won't pay any tax on dividends, on earnings, and you won't pay any national insurance either. So again, with the personal service company, you could have a salary up to 12,570 without paying tax for the last year. So will that be kept? To keep that a flat rate figure, so inflation will eat into that. But at least it's a way forward for us to have tax-free income even when we're living and working abroad. If you're property renting, property rental income is completely fixed in the UK, as is the capital gains of those personal assets. So unless you're buying the property through an investment company, your own company, you're going to have a personal liability to capital gains tax at up to 28%, and income tax at your highest marginal rate on that rental income. But again, if you're just an expat renting out your home while you're overseas, and your net income from that rental income is 12,570 or below, then you're not going to be paying any tax on that property rental income. So property rental can still be tax efficient for an expat living and working abroad For more information and guidance on that, contact us at proactpartnership.com. But they've hammered property taxes for property owners in the UK over the last 10 years, and we're not expecting any changes at the moment. Capital gains tax is a great tax for expats. If you've got a capital gains tax that arises in the UK from cryptocurrency or share sales, investment sales, asset sales, and you're already tax resident, then you could pay no capital gains tax. So that's saving you up to 20% on a capital gains tax. You have to get your ducks lined up on capital gains, not to make the mistake of making the plan wrong. So for an expat to plan that capital gains strategy, it's well worth a look at, and contact us at proactpartnership.com to make sure that you don't get retrospective taxation at 20% on your capital gain. If it's a sale of a business for 1 million, that could be a very, very expensive mistake to make. So instead of living in Monaco or Cyprus in the sun, you've got to make up that 20% lost tax to UK capital gains. It's interesting that there's some other types of taxes in the UK where you can get tax relief for venture capital investments. Now, these are great, but don't get sucked into the idea that the tax relief for venture capital tax plans is offering you a tax rebate. It doesn't give you a tax rebate. It gives you a tax credit against what you've earned. So if you've earned 200,000, I'm using round figures here. If you earn 200,000 in the UK and you've paid 60,000 tax in the UK, then you could make a £200,000 venture capital tax investment in a new venture capital business, and potentially get that 60,000 tax credit, so you don't pay any tax into that. So it's very tax efficient. But if you're not paying that £60,000 tax in the UK, you will not get that tax credit at all. Okay, there is still a potential benefit that there's no capital gains tax assessed on the sale of those shares in 5 years, but obviously you've got the risk aside for that. So for more information on timing and managing tax claims, contact us at proactpartnership.com. ProAct do UK tax returns for expats living and working abroad if they need to. This could be because you're just returning or just leaving the UK. Could be because you've got property rental or a capital gains tax liability. Whether that capital gains is from crypto or it's from investment sales or business sales, it's a different situation and a different circumstance. So contact us at proactpartnership.com for more information and guidance on that. The other big story that's doing the rounds at the moment on with the budget, it's well worth looking at, is pensions. Now, the good news is for people that are pensioners in the UK is that 10% indexation is going to be added to pensions from this April. So that's a big increase, for an annual increase for pensions for pensioners. So it could add 15 to 20 pounds a week onto a state pension, which is nearly £200 a year. So it's a big increase for pensioners in the UK. It's actually 2,000 a year, isn't it? So it's something to consider, that the UK state pension is worthwhile, and it is something to consider. That with the indexation, increasing the state pension by over £1,000 a year, it makes it even more of an attractive investment. So if you're an expat living and working abroad, you can top up and maintain your UK national insurance state pension benefits. So you don't get any other benefit from it other than it's topping up your state pension. So that as an expat, if you're newly expat, you can register straight away, and while you're working abroad for a few years, pay class 2 at 160 a year, and that will then give you an extra year's pension credit. If you need to backdate as an expat, you can backdate this year, and once you pay this year in March for 22-23, you can go back another 6 years. So that's 7 years worth of credit you can get. Now, if you can't, if you're not been paying class 2, you can only pay class 3, which is £15 a week, about 850 a year. But the pension you will get from that, you'll get that money back within 3 years. So within 3 years of retiring, you get that money back. So it's well worth. It's a good investment, especially later in your career. The return on your investment is relatively good when you look at low interest rates. When you look at other investments not being indexed linked, when you look at other investments, stocks going up and down, property prices under pressure because of inflation, a pension could be a good investment at the moment. So, and it can also be a tax planning tool as well. So consider that as a way of reducing your liabilities and providing funds for the future. For more information and guidance, contact us at proactpartnership.com. There's a once-off opportunity that's coming to an end. Now, that's been extended to July now. So up until July, you can pay an extra 10 years, back years. So again, if somebody has been expat out of the UK for long term, at the moment, potentially you could pay 17 years of pension credit. And bearing in mind 35 years gives you that full state pension. So it's going to add about £90 a week if you backdate all those years. And that's £90 a week for the rest of your life, and it's index linked to add into your pension. So it's quite a good return on investment if an expat is considering relocating back to the UK, or even if you just want to claim that state pension anyway. It's still an entitlement as a British citizen when you're living and working abroad, but you have to get to the 35 years to get the maximum state pension and 10 years to get the minimum. So we'll see if anything changes on that for that flexibility going forward. I'm not surprised they've extended the deadline by 3 months. It's a very shrewd plan because it's extra tax revenue, even though it's national insurance, going into the pot. So if people are motivated to provide more for their pensions, and it puts more money in the government's purse, then that's got to be good elsewhere in the system and taking some of the strains off that. So thanks a lot for listening to this webinar. This is our preview and an update on what's looking forward. I'm going to follow up this webinar, so subscribe now and look at the follow-up YouTubes that we'll do as they comment and update that going forward. Thanks a lot for listening. We'll see you next time.